Welcome to the FinTech Times News and Views podcast. Established in 2016, the FinTech Times is a global multimedia news outlet centered around the world's first leading FinTech newspaper. We report on the latest and brightest ideas from the FinTech world. Follow the conversation using hashtag TFD News and Views and follow us at the FinTech Times.
Thanks very much for taking the time to have a conversation with me. I really appreciate it. I think it was your sort of team sort of reached out to me, and it piqued my interest because you were talking about specifically the Japanese sort of yen and how the governments are using it as an economic stimuli with regards to bonds, etc. And I think that's kind of an interesting angle because most of the conversations I'm having with regulators and central banks, they're all very nervous about stablecoins because they can't control them. So I was really interested in that sort of viewpoint, as it were.
I mean, there are two sides of that same thing. Like when you look at the government side, it always looks as if like the stable coins are actually going out and they're taking the control away. But if done right, I don't like personally or particularly kind of agree to this point where like we feel that the government is losing control. It's more like giving, so the way like think about it, I'll give you a couple of examples. Like let's say if you look at the US economy, right? Like US economy, when you look at the petrodollar, right? The petrodollar overall, the demand for the petrodollar was in a way like reducing. And then stable coins came in and suddenly everyone wanted the US dollars because they had access to it. Which means that effectively, like if you look at both Circle and Tether combined, they are like I think the top 10 holders of the money market fund and the backing from the government side. So effectively it is just kind of going out and giving more power to any country's currency. Where the difference lies is between how they are traded. So if you look at India, right, the challenge with India is India has capital controls. Now if you have a capital control, then when you're getting out and like you make it like freely tradable, the problem that happens at that point of time is because at this point of time, like you have tried to go out and you are trying to go out and change the convertibility of like the currency. That is where the challenge comes in. And even there also, like I don't think it is massively like okay, having stable coins where the convertibility is not really like not really very open. It is still valuable because then you can actually go out and create usability on the transaction layer, which again solves like a lot of those problems around how we can kind of go out and increase like reduce the cost of doing the transactions, the speed at which the transactions can happen. So I mean, this would not be like a common answer for everyone. This would be like dependent on the geography where you are or the places where you are talking to. And that is where like it will heavily depend on jurisdiction on how a stable coin might impact like a particular economy in
So I guess obviously taking India as an example, obviously they have a individual limitation on the rupee equivalent of $250,000 being able to send out the country, don't they?
Yes.
So in that scenario, stable coins are not great because there's very little control in place that enable someone to buy effectively $500,000 worth of USDC and then transfer it wherever they want to go. So that particular example is where the problems can occur. But you're sort of saying in other jurisdictions like Japan, like UK, where there is no monetary restrictions on moving money in forwards, what difference does it make?
Yeah, exactly. And it actually kind of increases the utility of these currencies even more because now more and more people are accepting it. It is becoming freely tradable. So like I think the payment rails are going like without borders. I mean now the regulators, the way they have to think is like who essentially is able to like if the stable coins grow bigger, then there has to be like a proper regulation and regulator to kind of go out and make the right rules so that the interests of the people are protected rather than like having a positive or a negative impact with some
Yeah, I mean the sort of the idea that everyone sort of talks to me about when they talk about the dangers of stablecoin is when you're kind of getting into quantitative easing or some form of market economy manipulation by governments, which that's one of the ways that a central bank can issue more money, it can do other things. If it's a stablecoin, they don't have any control over it. But I guess that in itself is not necessarily a limitation if handled the right way.
Exactly. Like if you look at the both like quantitative easing as well as Like if you look at the way the stable coins are getting issued, effectively what would happen is like those stable coins will still be impacted by the way the government makes those decisions. So for example, like if you look at like the Fed rates going down, that impact would be the same for a bank, would be the same for like the stable coins as well. So ultimately I don't think like they fall beyond or like they're not impacted by all those things. They're equally impacted. They have equal kind of overall like the way people would kind of conceive them, because effectively if the yields are going down and people were holding the US stable coins because of the yield, they would stop kind of going out and holding it. So I mean a lot of that parlance is actually kind of the same. Like it does not actually go out and take away a lot of that power from the government. Like my always take has been like it actually goes out and empowers the government. It enables them. Now if the impact of people holding a US dollar is getting impacted by a federal decision, that same thing will apply on the stable coins. Yes, there is one thing which effectively kind of is like a challenge, where effectively what happens is like when you look at banks. So today, when you look at stable coins like a Genius Act has gone out and said that they do not like you cannot share the yields, and then people have found out beautiful ways to kind of go out and still figure out marketing spends. They have tried to go out and figure out some different aspects to it, point systems. I know there's so many ways to kind of go out and do it, but effectively, what this is kind of going out and impacting is the money that was sitting with the banks with literally zero interest rate. So the way, like if you look at the financial systems, this is where like a big impact is happening. And like I think this will continue to grow, where like banks who were having access to a capital which was very cheap, people do not want to hold it anymore. Why? Because they can alternatively hold stable coins in the same currency and they can start generating yields on top of it. The moment they can go out and do that, the capital will flow out of the banks, which means this reduces the capability of a bank to actually create credit, because effectively the money in the bank helps them to create credit, and it also kind of increases their cost of capital, because the low lying capital, which is like I often call as CASA, that is kind of going out and exiting the banks. And that is where like the real challenges come in. The alternate to that, I think if you look at JP Morgan's deposit token, I mean, that is like one good, clear example of how that can be prevented as well. So imagine like today, when let's say I am a high net worth individual, I have a JP Morgan account which has, let's say, $250,000, which I want to now move to Coinbase because I want to do something on Coinbase, whatever, XYZ reasons. Today, what is happening is I will take that money out of Coinbase. I will go to deposit and deposit it into Coinbase, Coinbase might be banking from some other company, and then buy USDC. The moment I buy USDC, that money flows to Circle's bank account, and then from Circle's bank account, it flows to the bonds or like the places where they would want to hold their treasuries into, which means JP Morgan now lost that money from the bank account. Having a deposit token can also solve for that, because the way deposit token would work is they would say, okay, you have a $250,000 sitting here. The deposit token or the confirmation for that is something that I give to Coinbase in the form of a JPMD token, a deposit token. The money can still lie here with JP Morgan, but this essentially JPMD token kind of is a reflection of the same $250,000, which I can now again use to buy anything on Coinbase. And like you don't have to actually go towards like buying the Circle's USDC and using it and like taking that money out. So that could be one way. And I think the way the word would converge is all these banks would have these deposit tokens globally, and then there will be probably one single currency which would be sitting in the center of kind of like working as a settlement currency, which is like someone sends money in JPMD, someone sends money in DBS stablecoin, and then ultimately when they have to cross settle among each other. So if you look at companies like Ubix, Ubix is a company which is actually working on solving this thing where they want to be the settlement layer where different stable coins come in from different places. Similarly, deposit tokens can come in from different places, and then you can choose in what stable coin or in what form you want the money in. They go out and become that settlement trail, convert it into whatever you want, and then settle it. So that is, I think, where we started with where the problem could be, but I kind of explained like the whole flow of how this might evolve in the future.
Yeah, I guess that's kind of interesting though. So what you're kind of saying is that the emphasis effectively is moving out of the government's hands that hold the actual fiat currency and moving more into the bank's hands or the custodian's hands, and they're going to be the ones that are effectively then going to control not the actual currency but the digital version of the currency.
Yeah, exactly. I think that is how it would evolve. There is an alternate word where like people think everyone will use stable coins. It can happen. I'm like not opposed to it, but I feel the version that I explained to you to be more plausible in the future, because now every bank can participate, every bank can like save their low capital amounts and like that way. But the problem that they all will have is like when it comes to settlement, nobody would want to accept the tag of some other bank. So there has to be someone centrally who's kind of going out and solving for that.
And I think that's the fundamental problem, is that with a lot of the new sort of payment solutions or whatever we want to call these digital assets, it's more about the existing financial services industry trying to protect itself from becoming irrelevant. In the utopian vision of Bitcoin, nobody owns anything, everyone has Bitcoin, it's the global only store of value. None of the current banking institutions want that, because that destroys their whole business.
Exactly. I mean, like that is exactly happening across the world. Like I think today European Union actually came out with like saying that this is like having a massive impact on the financial ecosystem. And I think that is like slowly and steadily, like either there would be like a lot of acceptance to that change, or like there will be people who will be like, no, we like they would not accept to it. And it's gonna be just like when like the papers used to exist, and then like a computer came in and everyone said, hey, we will not use the computer will not succeed. But here we are, like everyone sitting in front of a computer now. So it would kind of evolve in that same scenario. Like, yes, it will happen. It would be just in different shapes and forms.
And I guess obviously what that's going to mean over the next however years or whatever, we're going to see a massive explosion of stablecoins. Because if every bank's going to have one, every big tech company is going to have one, they're all going to want their own stablecoin at this moment in time. Is that sort of your prediction?
Yeah, exactly.
That we're going to have an explosion?
100%. Like I think we've still not seen, like we probably will see like we'll probably see like more than 10,000 stable coins actually coming into the picture. And then like effectively all those stable coins actually going out and creating that whole big confusion of like, there was $1, now there are 10,000, which one should I use? So that would happen, like because we are in that cycle where like if you look at any app, everyone wants to offer, like we're talking to a lot of applications which are like have nothing to do with finance, and they want to become the financial layer. So ultimately this is kind of like that place where it's kind of like a super cycle of stable coins. So everyone wants one, but then later they will realize it's not just about like you going out and minting a token. There has to be a utility attached to it. There are 10 different things that you have to build around it. And that's why like as Polygon, like all these blockchains are effectively going out and launching their own stablecoins, and they're partnering with this. The problem that I have with them is like fundamentally as a blockchain, I cannot go out and do that, because first you kind of go out and become an instant enemy for every other stablecoin. And the second thing is like people do not want someone else's branding. Like this has been a very significant thing. Like if you look at Visa, when it started, the Visa started as a Bank of America thing. And if you look at the initial 5 years, everyone was like, why should I use a Bank of America thing? And then slowly and steadily when Visa moved out, became a consortium, all the banks came in, and that was where the acceptability came in. So you have like money has to be neutral. The moment you color that money, it becomes relevantly like little bit difficult. Like if you look at PayPal has PYUSD, but would like someone like let's say Robinhood want to adopt PYUSD? Why? No, they would say no, I don't want to, because you are coming in and like you probably will have all the data about my spending patterns, about my company's spending pattern, my users' data. I would not give that to you. So that's why we will see like a lot of those thought processes, but then at the end, someone who is like really well executed would be someone who has remained neutral, someone who's just kind of enabler. And like they are not kind of going out and picking and choosing what your stablecoin has to be or what it has to be called. And that's why these ultimately settlement companies would become very prominent in the future, because they are the ones that would effectively go out and settle this chaos. A lot of them will just shut down because there was no demand for them. There was no use case for them. They just launched it because everyone was launching. So all these things, I think, like we are at the very beginning of all these things, and in the next 5 years, all this will happen. I think in 5 years, my projection is that there are going to be like 100,000 stable coins at least.
Wow. And I guess for all of this, there was this sort of holy grail moment for consumers thinking that the cost of transferring money across borders and overseas was going to drop completely to zero because they could move a stablecoin from one to the other. Do you think that's not going to be achievable now, and that's not going to happen, or do you think it will happen but to a much smaller effect?
It's not going to happen right now because the problem is the regulatory arbitrage is still massive. Like, I'll give you an example. If you go to Singapore, Singapore I think has approved 1 or 2 entities to kind of be able to go out and on-ramp and off-ramp. Like, one of them is called as AAA. There's another one, I'm not remembering the name. Just kind of giving you an example here, is like when you want to go out and on-ramp on Grab on Polygon, you have to actually shill out like 3 to 5% just to on-ramp. I mean, I can send my money cross-border at 1% or 2% using the current rails. Here you lose like 5% just to kind of go out and use stablecoins. So these regulatory arbitrages exist right now, and they will continue to exist till like a lot of people actually start kind of going out and get the licenses. Similarly, if you come to like Middle East, like the banks here, just to open a customer account, customer custody account, they would charge 100,000 to 100,000 just to kind of go out and open an account. So all these things effectively right now they have not kind of reduced that cost. But ultimately, like the other way of this is don't off ramp. Like, why do you want to off ramp? So the thesis that we are thinking about from Polygon's perspective is, what if we can give you everything that your bank gives you, and so you don't have to actually off-ramp because all those services are already available on Polygon itself. So you want to go and pay your wages. You have examples like Toku, which can integrate and give you stable coins. You want to go out and make payments, then basically you have your debit cards, credit cards that are getting issued on Polygon. So that way, like I think this whole world will be like the more and more like the usability of stable coins and the utility of stable coins start happening on like the blockchains, the off-ramp will stop. And once the off-ramp stops, your cost will reduce. And then like at the end, since there will be so many people, the competition would be so fierce that ultimately only those will win that effectively are kind of ready to give like everything for free. So it's basically commoditization of the stable coins and the payment infrastructure. And then you don't earn because like even today, like if you look at the Indian infrastructure of UPI, no bank earns on the transaction that are happening. But the way they earn is like they've created an app on top of it where there are 20 different services that they're kind of going out and giving, and that is where they're generating revenue from. Similarly, PayPal, Venmo, Revolut, everyone, like, so that is where like it has to evolve to. And then like all these stable coins would just effectively go into the backend, where like you are just still seeing like you approve that these are the 3 stable coins or 2 stable coins that I want to receive money. What would happen is if someone is sending you any different stable coin, this there will be something called like, let's say, a mesh, which is just taking or settlement service, which will take these stable coins and only settle the stable coins that you want. So once that, and that's where like you will have all this abstracted away. So you don't care like who's paying you in what stable coin, because ultimately you've chosen, let's say, USDC, so you're getting the money in USDC.
And I guess that's in the power of potentially some rather large merchants. You might maybe look at someone like an Ant Financial or an Amazon. If I'm spending all of my money on Amazon products and Amazon starts asking me to pay in USDC, for example, which probably wouldn't happen, or their own Amazon coin, they would have a little bit of an advantage in the market because a lot of what I want to buy is already there on their platform.
Exactly.
Can you see that having a major effect on the sort of the future? I'm guessing one of the things, as you said, is 1,000 different stable coins. Amazon could bring out their own stable coin, but by them doing it, is that going to have more of a consumer change than a bank doing it, for example, that doesn't actually have anything that anyone wants to buy?
I mean, as long as like I think there will be changes, there will be a little bit customer behavior change, which is like a customer, if I am doing most of my thing in one single app. Like if you look at Dubai, there's an app called Noon here. So Noon is basically an app for everything. Apart from like booking cab, you can do everything on Noon. You have a mall on that, you have a 15-minute delivery on that, you have food delivery on it. So all the things that you would ever want to do is already sitting here. Now, if you have something called, let's say, a moon dirham, for example, hypothetically, I mean, and I usually kind of go out and do everything on Noon, what it will have as an impact is like I would want to keep my money on Noon because I know then I don't have to go through the cards, I don't have to put OTPs every time, I don't have to put CVVs of cards, and and basically Noon can actually, because Noon is no more kind of paying the fee for the MasterCard, Visas of the world, they can actually lower the cost of that. So my incentive to kind of go out and buy that would be the goods. If I am buying using this particular service of the stable coin, the goods are cheaper, and without using it, using credit cards or debit cards, the price is high. So of course I would want to kind of go out and onboard here. The beautiful thing, I think this is someone like recently I met who's building something like this. So when you have like your balances in your bank account, ultimately what happens is the bank's debit cards give you a lot of offer because they are sitting with a lot of capital inside like the bank account. If you look at the Coinbase credit card that got issued, the Coinbase credit card actually goes out and says that you have to keep around somewhere between $10,000 to $200,000, and based on that you will get different discounts, right? So ultimately what is happening is that money, instead of like the bank having it, Coinbase is having it, which means now Coinbase actually can use that money for various purposes that they want to, which means they can generate return on top of it by kind of using it. So let's say they just want to use it as a warehouse facility for your own credit card, or they want to deposit it into, to convert it into USDC. Effectively they have ways to make money. And this can actually kind of go out and change the behavior in the sense of like when you go out and give these incentives on debit cards, you can have those same incentives by just having balances on in stable coins. And this is actually happening now. Apart from like Coinbase, like there's a program that like MakerDAI is kind of working on, the Sky protocol, where the money that you have logged into Sky protocol is kind of giving a yield to Sky protocol. So instead of them passing the yield, what they would do is they would say, okay, because you have 100,000 in Sky, we will give you these lounge accesses for free. But ultimately the price of they are paying for the lounge accesses is much cheaper as compared to the interest they would pay. So they are still making money, and this whole setup of like this having a card comes on chain. So that is fundamentally how like these consumer apps will become dominant. And like I think I've started seeing that with a lot of gaming apps. Like a lot of gaming apps, if you look at a company called Keygen has something called a Kcash. Everyone in the app effectively kind of gets paid in Kcash. The way Kcash effectively is set up, Kcash actually goes out and gives you, like, it's backed by USDT. So for every 1000 Kcash, 1 USDT is there. So ultimately that is happening. So this is something where a lot of in-game things are happening, because a lot of these games effectively are saying, hey, nobody cares about the branding here, they want the money, and if they're getting benefits from here, we will use it. So there are signs which are clearly telling us that this behavior is happening.
I think it's going to be interesting, isn't it? It's kind of like, as you say, it's not going to be a very quick avalanche of change. It's
Correct.
going to be a continual, slow progress towards something else. And obviously that also allows for other new items to come in as well, which is a little bit like, you know, if you look back to CBDCs at one point seemed to be all the rage.
Yeah.
Every government was thinking about it, and then all of a sudden we never talk about them anymore. Now we're only ever talking about stablecoins. So
Exactly.
Do you think there's anything, you know, thinking about the future, is there anything else you think that could come in and disrupt this progress of stablecoins or change it in any significant way?
I think it would not disrupt. So there are two things, like the way you look at CBDCs, why CBDCs did not get like a lot of traction. And there's a very simple logic behind it. You cannot use it anywhere. Like, I have a CBDC, what do I do with it? Because effectively when you're looking at blockchains, the way it is happening is the asset is sitting on the same blockchain, and like you're making the purchase on the same blockchain. Correct? Which means like if I, like for JPYC, I think one of the biggest things about JPYC is like I want to buy, let's say, a token or an NFT or whatever on chain, a money market fund, whatever. JPYC on chain enables me to buy all these things because it is sitting on chain and all these assets are sitting on chain. The challenge that you have on the other hand is with CBDCs. CBDCs are sitting on siloed islands which are built on either R3 Corda or Hyperledger, and they don't have assets. So what do I do with CBDC? And that is like the biggest challenge that these CBDCs have. Maybe like for central bank settlement currencies, like the central banks settle among themselves using CBDC. And I think if you look at BIS, they're running a pilot which is called as Project Agora, which is like 10 different currencies. They want to kind of have an interbank settlement. I think those at like the government level, CBDCs will still kind of find some footing. Retail side is going to be super difficult because stable coins have made it like much easier for you to go out and do that. The only thing that it will evolve to is like it would be like a 3 model system. CBDCs, if they are able to be successful, otherwise a 2 model system, which is like deposit tokens by the banks and the financial institutions of their own, and stable coins at the by like either the financial institutions or the companies like Circle across the world. They will go out and they will start issuing these stable coins, and they both will kind of work together to create like the way in which like the stable coins evolve and the whole economy of the digital assets evolve.
It happens